Imagine waking up one morning to find your dream home worth half what you paid. Your neighbors vanished overnight. Banks collapsed, and your retirement funds evaporated. This isn't a scene from a dystopian movie, but a stark echo of the 2008 financial meltdown, when greed and reckless financial practices built a towering house of cards that eventually crumbled, leaving millions devastated and entire economies in turmoil. In 2008, subprime mortgages and toxic debt were packaged and sold with their glass AAA ratings by complicit credit agencies, luring families into loans they couldn't possibly afford. And when the music stopped, the collapse was both swift and brutal, wiping out fortunes and homes in a matter of days. Today, as we edge closer to 2025, there are ominous signs that history may be repeating itself, but with even more perilous twists. Interest rates are climbing relentlessly, inflation is devouring savings, and yet housing prices continue to defy logic. Imagine a 500-square-foot condo in Miami, selling for over $1 million, or bidding wars in Toronto, turning homes into high-stakes lottery tickets, while corporate investors, such as hedge funds and private equity giants, are snapping up entire neighborhoods as if they were mere properties on a monopoly board. This new crisis is not just a rehash of old mistakes, but an evolution driven by algorithmic trading that pushes real estate prices to artificial heights, unprecedented climate risks that threaten to render prime areas unlivable through catastrophic floods in Florida or wildfires in California, and a generation burdened by crippling student debt that struggles to break into the market. In this perfect storm, familiar villains re-emerge. Subprime loans are now cloaked under terms like non-prime or alternative documentation mortgages. Predatory lending practices are rebranded as fintech innovation, and speculative bubbles have expanded beyond housing into the realms of cryptocurrency, NFTs, meme stocks, and even the futuristic market of metaverse real estate. As we look toward 2025, the same reckless strategies that fueled the 2008 collapse appear to be resurfacing in new, more insidious forms, hinting at a future where financial instability could once again upend lives and communities. Warning signs abound. U.S. household debt, which soared to $12.5 trillion in 2006, has now ballooned to $17.5 trillion, while mortgage delinquency rates are creeping upward, and dubious liar loans, where borrowers exaggerate their income, have made a comeback in the guise of self-reported income apps. Meanwhile, the Airbnb effect has transformed entire cities into short-term rental markets, inflating home prices and rents until the bubble is ready to burst. Central banks now find themselves in a perilous balancing act. Raise interest rates to tame inflation and risk making mortgages unaffordable, or lower them and potentially ignite runaway inflation. A lose-lose scenario that threatens to leave Main Street reeling. Yet, in every crisis, opportunities for savvy investors and prudent homeowners arise, echoing Warren Buffett's timeless advice to be fearful when others are greedy, and greedy when others are fearful. Those with foresight are already repositioning themselves to capitalize on the impending downturn by maintaining liquidity to seize fire sale opportunities, targeting distressed markets in cities like Phoenix, Austin, or even international hubs such as Lisbon, where current overheated conditions may soon give way to bargain-priced opportunities, and betting on the rental market, which is poised for explosive growth as home ownership becomes increasingly out of reach. Diversification into emerging global markets like Vietnam or Colombia, where entry points remain affordable, could also pave the way for significant long-term gains, while sophisticated financial instruments such as ETFs that allow investors to short the housing bubble offer avenues to profit from the inevitable downturn. However, caution is paramount. History has shown that being the greater fool by investing in overvalued assets without a clear understanding of underlying risks can lead to catastrophic losses. And the same mentality that fueled the purchase of unsustainable McMansions in 2008 must be avoided at all costs in the coming crisis. Instead, it is critical to remain grounded, follow the data, and act swiftly when early signs of collapse appear. Whether that means the first major bank falters, for lease signs suddenly outnumber sold stickers on neighborhoods, or abrupt shifts in Federal Reserve policy trigger widespread panic across global markets. In this rapidly shifting economic landscape, property owners must stress test their finances. Renters need to save aggressively, and investors should diversify their portfolios beyond traditional real estate assets. As we stand on the precipice of what could be the most significant financial upheaval since 2008, the choices made today will determine whether we end up holding the keys to empty homes or seizing a once-in-a-generation opportunity to rebuild wealth from the ruins. History may not repeat itself exactly, but it does often rhyme, and the echoes of past mistakes are all too evident in the complex modern web of finance. The path forward demands vigilance, strategic foresight, and an unwavering commitment to financial literacy. For within every crisis lies the potential for renewal, the chance to lay the foundation for the next great economic empire. The future remains uncertain, but those who are prepared, who recognize the warning signs now and act decisively, will be the ones to transform chaos into a resilient, future-proof legacy.